Welcome back to the deep dive. Today, we're not just looking at a historical event. We are walking onto a crime scene.
Hmm.
But this isn't your typical crime scene. There's no yellow tape, no chalk outlines. The weapon here was a calculator. The accomplices were, well, everyone from the highest paid bankers on Wall Street to maybe your neighbor who bought that third investment condo.
And the victim was the entire global economy. It's good to be here. And crime scene is, I think, exactly the right way to frame this.
It feels that way.
It does.
Yeah.
We're essentially reopening a cold case because the scale of the damage is still, it's still hard to really wrap your head around.
It really is.
We're not talking about a bad quarter for the stock market. We're talking about just the vaporization of wealth on a scale that's hard to comprehend.
Right. Let's just hit our listeners with that headline number right away, just to set the stage. $13 trillion.
That is the number. U.S. household net worth plunged by nearly $13 trillion from its peak in 2007.
That's a 20% drop.
20%. Yeah. Just stop and think about that. Imagine 1/5 of everything American families owned. Their savings, their home equity, their retirement funds, just gone. It vanished into thin air.
It's a number so large it almost becomes abstract. It sounds like something from astronomy, not economics. But if you lived through 2008, you felt it.
Oh, absolutely.
You saw the for sale signs just multiplying like weeds on every street.
Yeah.
You saw office towers emptying out, people carrying those cardboard boxes. You felt that pit in your stomach when you went to the ATM, wondering if it was actually going to give you cash.
That fear was real. The system, and this isn't an exaggeration, the system actually froze.
So today we're unpacking the subprime mortgage crisis, but we're not going to do the dry textbook version. We're going to treat this like a detective story. We want to understand how the American dream, the dream of homeownership, was weaponized.
Exactly. Our mission today is to strip away the jargon. We've got a massive stack of sources here. Reports from the Financial Crisis Inquiry Commission, the FCIC, we've got Federal Reserve data, archives of what people were actually saying at the time.
And looking at this stack, I have to say, it reads like a conspiracy thriller.
It does. But the twist is, it wasn't some secret conspiracy happening in the shadows. This was all happening in broad daylight.
That's the crazy part.
And as the experts in these reports note, this wasn't just one bad bank or one bad law. It was a multinational financial crisis. It involved regulators who were, frankly, asleep at the wheel, credit rating agencies that were playing a completely rigged game, and yes, consumers who were signing papers they just didn't read or understand.
So let's find the smoking gun, or I guess the thousands of smoking guns. I want to start with the aha moment I had digging through these sources. There was this specific financial innovation, and we're going to get into the weeds of it, that essentially turned dross into gold. Financial engineers found a way to take terrible, incredibly risky loans and dress them up as the safest investments in the world.
And that innovation didn't just happen in a vacuum. It was fueled by something else, this giant pool of money that was just circling the globe looking for a home.
That is the perfect place to start. To understand the collapse, we have to understand the setup. We have to go back to the years between 2000 and 2006.
The bubble years.
Exactly. So paint the picture for us. The dot-com bubble had just burst. 9/11 had happened. The economy was on the ropes. What did the Federal Reserve do?
They panicked, arguably. The Fed, led by Alan Greenspan at the time, was terrified of deflation. They saw what happened in Japan, the lost decade, and they wanted to stimulate growth at any cost.
So they pulled the biggest lever they have.
They did. They lowered interest rates. They did it aggressively. The federal funds rate went from 6.5% in the year 2000 all the way down to just 1% by 2003.
1%. It's basically free money. If you're a bank, you can borrow from the Fed for almost nothing.
Exactly. And when money is that cheap, you don't just sit on it. You have to lend it out to make a profit. But there was this other massive force at play here, something Ben Bernanke, who was a Fed governor then, called the global savings glut.
The famous giant pool of money. I love how the team at NPR described this back in the day. It's such a great visual. It's like there was this massive reservoir of cash accumulating in the world, and it just had to go somewhere.
It's the perfect visual. Think about what was happening. You had these fast-growing economies in Asia, particularly China, running huge trade surpluses with the U.S.
So they're selling us TVs and toys, and we're sending them billions of dollars.
Billions and billions. And you also had oil-producing nations, Saudi Arabia, Russia making money hand over fist as oil prices soared. So by the mid-2000s, there's about $70 trillion with a T.
70 trillion.
$70 trillion worldwide in fixed income investments, all looking for a home.
But they couldn't just, stuff it under a mattress. They needed safety.
Correct. We're talking about sovereign wealth funds, central banks. They aren't gambling on penny stocks. They want safety and a steady return. And historically, the safest place in the world for that money was U.S. Treasury bonds.
But there's the catch.
There's the catch. Remember, the Fed had cut rates to 1%.
So if you buy a U.S. Treasury bond, you're making almost nothing. You're barely keeping up with inflation, if that.
Exactly. So this $70 trillion was hunting for yield. It was desperate. It was basically knocking on Wall Street's door saying, I have billions. I need a safe place to put it, but you have to get me a better return than 1%.
And Wall Street, being Wall Street, said, don't worry, we can build a product for you.
And that product was mortgage debt. The U.S. housing market was seen as the safest bet on the planet. I mean, the phrase is safe as houses, right?
That phrase, safe as houses, is doing a lot of heavy lifting here. Before we get into the financial engineering, we have to talk about the psychology on the ground.
The mania.
Yes, the mania. Reading these sources, the phrase irrational exuberance just keeps coming up over and over again. There was this widespread, unshakable belief that housing prices would never fall.
Not just that they would go up, but that they literally could not go down on a national scale.
It seems insane in retrospect.
It's the definition of a bubble. It's a belief that defies all historical reality. And look at the data from the Fed archives. Between 1997 and 2006, the median house price in the U.S. increased by 124%.
124%. So let's just break that down. That's doubling, and then adding another quarter on top of that in less than a decade. If you bought a house for $200,000, suddenly it's worth close to $450,000, and you didn't do a thing. You just lived there.
It felt like magic. It felt like you were a financial genius just for owning a home. And because prices kept going up, homeownership rates hit an all-time high of 69.2% in 2004.
It became a no-lose proposition in people's minds.
Completely. Even if you couldn't really afford the monthly payment, the logic was, well, it doesn't matter. I'll just sell it in a year for a $50,000 profit, or I'll just refinance when the value goes up and pull out cash.
It stopped being about shelter and started being about speculation. And the data here is just wild. By 2006, the sources say nearly 40% of home purchases were not intended as primary residences.
That's a staggering statistic. Let that sink in. 40%. These weren't families looking for a backyard for the dog or a good school district.
No.
These were investment properties, vacation homes, or just pure naked speculation. You had people flipping condos.
Describe that for a second, because that flipping culture was intense. You had entire TV shows dedicated to it.
Oh, absolutely. It was everywhere. You had people in Miami or Las Vegas putting down a small deposit on a condo that hadn't even been built yet.
Yeah.
They were buying the contract to purchase.
So they're buying a piece of paper.
They're buying a piece of paper. Then, 6 months later, before the building is even finished, they sell that paper contract to someone else for, say, $50,000 more. The condo is still just a hole in the ground, but the paper value has skyrocketed.
It turned housing into a form of day trading for amateurs. But here's the problem. To keep this machine going, to keep feeding that giant pool of money with new mortgages,
You need more borrowers.
Wall Street needed more raw material for their bonds.
And this is where they hit a wall. In a normal, functioning market, there are only so many people with good credit scores, a steady job, and a 20% down payment.
The prime borrowers.
Right. By 2003, 2004, the banks had largely run out of those people. Everyone who was qualified and wanted a house pretty much already had one.
But the giant pool of money is still hungry. It wants more of these mortgage bonds that pay 3, 4, 5%.
So Wall Street had a choice. They could either stop selling the product that was making them fabulously wealthy, or they could lower the standards for the raw material.
And we know which one they chose. Which brings us to our second section, the fuel. We have to talk about subprime lending.
This is the real turning point.
Mm-hmm.
Subprime technically isn't a dirty word. It just means borrowers with weakened credit histories. Maybe they missed some payments in the past. Maybe they have a high debt-to-income ratio.
Right. It was a niche market for a long time.
A very small niche. In 1994, it was about 5% of all mortgage originations. Maybe $35 billion. It was for people who were, getting back on their feet.
But by 2006?
By 2006, subprime was 20% of the entire mortgage market. $600 billion in a single year.
That's an explosion. It's a more than tenfold increase. But it's not just that they were lending to people with lower credit scores. It's how they were lending. The standards didn't just get lower, they vanished.
They did. The sources describe this alphabet soup of loan types that sound like a comedy sketch if the consequences weren't so tragic.
This is the race to the bottom.
It really was. It started with things like SIVA loans. That's stated income, verified assets.
Stated income. That's a very polite way of saying liar's loan, isn't it?
Pretty much. The borrower just states on the application, I make $100,000 a year, and the bank says, okay, great, we believe you.
Yeah.
They might verify your assets, like your bank account, but they don't ask for pay stubs or tax returns.
And then it got worse.
Then it got worse. You had neither no income, verified assets, and then finally the absolute bottom of the barrel, the NINO.
The NINJ loan, which stands for
No income, no job, or assets.
no income, no job, no assets.
You could literally walk into a mortgage broker's office, have no job, no money in the bank, and walk out with a loan for $500,000. The running joke at the time, which was not a joke, was if you can fog a mirror, you can get a loan.
I was reading this one anecdote in the FCIC report about a strawberry picker in California. This guy made maybe $14,000 a year. He spoke almost no English, and somehow he was given a loan for a house worth over $700,000.
And you have to ask, how does that even happen? Who signs off on that?
The mortgage broker signs off on it, and this is the key to the whole puzzle. The broker doesn't care if the loan is ever repaid.
The incentives were completely perverse.
Explain that.
The broker gets paid a commission, an origination fee, for selling the loan. The minute the papers are signed, the broker gets their check, and the loan is sold up the chain to a big bank. The broker has zero risk.
So their job isn't to make a good loan, it's just to make a loan. Any loan.
In fact, it was worse than that. Brokers were often paid more, something called a yield spread premium, if they could convince the borrower to take a loan with a higher interest rate than they actually qualified for.
That's predatory. That is literally incentivizing someone to rip off their own customer.
It was standard practice. And the loan products themselves were traps. We have to talk about the teaser rates.
The exploding loans.
Yes. Imagine a 228 adjustable rate mortgage, an ARM. For the first 2 years, the interest rate is practically zero, 1%, 2%. Your monthly payment looks incredibly affordable.
So you think you can handle it?
You do. But at month 25, the rate resets. It jumps to whatever the market rate is, plus a margin. It could explode to 9, 10, 11%. Your monthly payment could double or triple overnight.
And the sales pitch from the broker was always, don't worry about the reset. In 2 years, your house will be worth so much more, you can just refinance into a better loan.
Exactly. The entire system was predicated on one thing: house prices going up forever.
And then there were the option ARMs. These are the ones that really blow my mind. You could choose to pay less than the interest you owed each month.
It's called negative amortization, and it's as bad as it sounds. Let's say the actual interest on your loan is $2,000 a month. The bank says, hey, you only have to pay $1,000 this month if you want.
Sounds great.
It sounds great.
Yeah.
But that missing $1,000 doesn't just disappear. It gets added to your total loan balance.
So your debt is actually increasing every month, even though you're making payments.
You are literally paying the bank to go deeper into debt. It is financial suicide. But again, if you believe your house is gaining $5,000 in value every month, you don't care. You think the house is earning money faster than you're borrowing it.
The stats from the period are they're shocking. In 2005, the median down payment for first-time homebuyers was only 2%. 43% put nothing down at all.
Zero down. You could buy a $400,000 asset with no skin in the game whatsoever.
So, okay, we have the strawberry picker with the $700,000 loan. We have the mortgage broker who got his commission and, I don't know, bought a boat. But here's the mystery. Why would a big bank, a sophisticated financial institution like Bear Stearns or Lehman Brothers, buy that loan? Why would they want a loan that is almost guaranteed to default?
And that brings us to the engine of the crisis, the machine that made it all possible: securitization.
We need to unpack this carefully because this is where a lot of people's eyes glaze over. But it's actually not that complicated if you use the right analogy.
It's not. The concept is simple. Historically, banking was what's called originate to hold.
Like in It's a Wonderful Life.
Exactly.
Yeah.
George Bailey at the Bailey Building and Loan. He lends you money to buy a house. You pay the building and loan back every month for 30 years. If you don't pay, the building and loan loses money. They knew you, they checked your credit, they had a stake in your success.
But that's not what was happening in the 2000s.
No, the model shifted completely to originate to distribute. The local bank or mortgage broker originates the loan, but they don't keep it. They sell it almost immediately to an investment bank on Wall Street.
This creates what the economists call a moral hazard.
A massive moral hazard. If the bank sells the risk the moment the loan is made, do they care if the borrower defaults?
They have no reason to. The risk is gone.
So Wall Street buys thousands of these loans, good ones, bad ones, NINJ loans, and throws them all into a giant digital pot.
They bundle them. And these bundles are called Mortgage-Backed Securities, or MBS.
Correct. Now imagine that pot of loans is like, well, a giant vat of chili. You've got some prime cuts of steak in there, but you've also got a lot of gristle and fat and things you'd rather not identify.
A wonderful image. Go on.
Wall Street takes that vat and they create a product from it. And here's the magic trick. They slice that product into different layers. These are called tranches, which is just French for slice.
And this is the water bucket analogy I saw in a few of the sources. I think this really helps clarify it.
It's the best one. Imagine a waterfall. The water is the monthly mortgage payments coming in from all the homeowners. And that waterfall flows into several buckets stacked vertically, one on top of the other.
The top bucket gets filled first.
The top bucket gets filled first. It's the senior tranche. As long as money is flowing, this bucket gets full. So if you buy a bond from this top bucket, you get paid first. Even if a few homeowners stop paying, if the water flow slows down a bit, that top bucket is still going to get filled.
And because it's so safe, so likely to get filled.
The credit rating agencies, Moody's, Standard & Poor's, Fitch, they come in and they stamp that top bucket AAA. They say it is as safe as a U.S. Treasury bond, the safest investment on earth.
Okay, so once the top bucket is full, the water overflows into the next one down.
Right. That's the mezzanine tranche. It only gets paid after the senior guys are paid in full, so it's riskier. To compensate you for that risk, it pays a higher interest rate. This might be rated, say, BBB.
And the very bottom bucket.
That's the equity tranche, or as the traders on Wall Street called it, the toxic waste. This bucket takes the first losses. If even a few homeowners default and the water flow slows, this bucket stays empty. The investors who bought this piece get nothing. They're wiped out.
Okay, so on the surface, this seems logical. Investors can choose their level of risk. The problem, as the FCIC report points out, was that Wall Street had too many subprime loans. They had too much of this toxic waste and this mezzanine stuff that nobody wanted to buy.
That's right. The giant pool of money, those global investors, they only wanted the safe AAA stuff. There's a glut of the risky slices.
So what did they do?
So they did something that was either brilliant or diabolical, depending on your point of view. They took those unwanted, risky middle buckets, the BBB-rated stuff, from hundreds of different mortgage bonds, and they pulled those together into a new pile.
So they're creating a new pile made up of purely risky stuff.
A pile of nothing but B-level tranches. And they ran that pile through the waterfall machine again. This new structure is called a CDO, a Collateralized Debt Obligation.
So it's a security made up of other securities, a bond made out of other bonds.
It's a sausage made out of the gristle and leftover bits from the first sausage.
That is deeply unappetizing.
It's financial alchemy. Through complex statistical modeling, they argued that because these BDB tranches came from different mortgage pools all over the country, some in Florida, some in California, some in Arizona, they were diversified, they wouldn't all default at once.
So they convinced the rating agencies.
They convinced the rating agencies that the top portion of this new pile of risky debt was somehow magically safe again. I mean, it's unbelievable, but 70 to 80% of this new CDO structure was rated AAA.
This is the dross into gold moment. They took financial junk, repackaged it, and slapped a AAA sticker on it. And the rating agencies, the so-called independent referees, they just went along with this.
Went along with it is putting it very mildly. The sources highlight a massive, glaring conflict of interest here. You have to ask, who pays for the rating?
The bank. The investment bank that's creating and selling the CDO.
Correct. The issuer pays. So imagine you're Goldman Sachs. You go to Moody's and say, here's our new CDO. We want a AAA rating. If Moody's says, wait a minute, this stuff looks like garbage. We're going to rate it junk. What does Goldman do?
They just walk down the street to S&P.
Exactly. They say, fine, we'll take our business to S&P. Maybe they'll be more cooperative. It was called ratings shopping.
And the agencies were competing for this business.
Viciously.
Yeah.
They were making hundreds of millions of dollars in fees from this business. There are internal emails that came out in the FCIC report where analysts are basically joking about it.
I remember one of these.
One S&P analyst writes to another, let's hope we are all wealthy and retired by the time this house of cards blows up. Another one famously said, we rate every deal. It could be structured by cows, and we would rate it.
Structured by cows. That tells you everything you need to know about the integrity of the process.
They had every financial incentive to look the other way, and their computer models, the things they used to justify the ratings, were fundamentally flawed.
Because of that one big assumption.
That one core assumption. They assumed that because housing prices had never fallen nationwide all at once since the Great Depression, that they never would.
The famous diversification fallacy. They thought a default in Miami had no connection to a default in Las Vegas.
Exactly.
Yeah.
They didn't realize that the financing was the national contagion. When the credit spigot turned off, it would turn off everywhere at once, and all their diversification models would be worthless.
So to recap, we have the bad loans, the fuel, we have the CDO machine turning them into fake safe assets, the engine. But there's one more piece that turned this from a messy housing correction into a global system-threatening catastrophe. We need to talk about the accelerant.
This is where the story gets really dark. This is the shadow banking system and the concept of leverage.
What is shadow banking?
When we think of a bank, we think of that building on Main Street with a vault and tellers. That's a depository bank, like Bank of America. It takes deposits from you and me. It's heavily regulated. It has to keep a certain amount of cash on hand.
But there was this whole other system operating in parallel.
The shadow banking system. These are the big investment banks. Lehman Brothers, Bear Stearns, Goldman Sachs, hedge funds, strange entities called SIVs, structured investment vehicles.
What did they do?
They acted like banks. They borrowed short-term and lent long-term, but they didn't take deposits. They weren't regulated like banks. And they funded themselves by borrowing massive amounts of money, often overnight.
And they used extreme leverage.
Leverage is just a fancy word for using borrowed money to invest. If I have $1 of my own money and I borrow $9 to buy a $10 asset, I am leveraged 10 to 1.
Which is great if the value of that asset goes up.
It's fantastic. If that $10 asset goes up by 10% to $11, I've doubled my money. I made $1 on my original dollar, 100% return.
But if the asset drops by 10%,
You've lost everything. The asset is now worth $9. You still owe the $9 you borrowed. Your original $1 is gone. Your equity is completely wiped out.
So now, consider this fact from the sources. By 2007, some of these major investment banks had leverage ratios as high as 40 to 1.
40 to 1. Let's just do the math on that.
Yeah.
That means for every $1 of their own capital, they were playing with $40 of borrowed money.
So a tiny drop in the value of their assets would wipe them out.
A tiny drop. At 40 to 1 leverage, a drop in your asset value of just 2.5% makes you insolvent. Your capital is gone.
2.5%, that's nothing. That's a bad Tuesday in the stock market. And we're talking about housing prices that had risen 124%. A 2.5% correction was not just possible, it was inevitable.
It was. But they felt safe. Why? Because they were holding all these AAA-rated CDOs. They believed their own lie. They thought these assets were bulletproof.
And to make matters even crazier, they were buying and selling insurance on these assets. But this wasn't normal insurance. This brings us to credit default swaps, CDS.
A credit default swap is, at its core, a side bet. It's an insurance policy against a bond going bust.
Yeah.
If I buy a bond, I can also buy a CDS from you. I pay you a small premium. If the bond defaults, you, the seller of the swap, have to pay me the full face value of the bond.
But here's the twist that turned it into a weapon of mass destruction. You didn't have to own the underlying bond to buy the insurance on it.
That is the critical world-changing difference. It's like buying fire insurance on your neighbor's house. You don't own the house. You have no insurable interest. You are simply betting that it will burn down, and you want to get paid if it does.
And it's not just you. 10 other people, 100 other people can all buy fire insurance on that same house.
Exactly. You could have a CDO worth $100 million, but you could have $1 billion in CDS bets riding on its performance. This is how the potential losses in the system were magnified infinitely. This led to the creation of synthetic CDOs.
Synthetic, meaning it's purely artificial.
It means there are no actual mortgages, no actual homeowners involved anymore. It is just gamblers making bets on the performance of other bets. You had hedge funds who would actually help banks design CDOs that they knew were full of garbage loans.
So they could bet against them.
Precisely. So they could turn around and buy CDS from someone else, betting that the very product they helped create would fail. It's like helping someone build a car with no brakes just so you can bet on it crashing.
The big short trade.
That's the one. But for every person making that bet, there had to be someone on the other side. Someone selling all that insurance.
And that someone was at AIG, American International Group, a big, boring global insurance company.
Or so everyone thought. But there was a tiny division, a little office in London called AIG Financial Products.
And what were they doing?
They were selling these credit default swaps by the hundreds of billions. They looked at the AAA ratings on these CDOs and thought it was free money. They said, these bonds will never default. We'll just collect the insurance premiums forever and get rich.
They were picking up nickels in front of a steamroller.
A perfect analogy. And because CDS were unregulated, they didn't have to put up any real collateral. They didn't have the cash reserves to actually pay out if all those houses they insured started to burn down at the same time.
They were insuring the apocalypse, betting that the apocalypse would never happen.
And that's the final piece of the puzzle. The stage is completely set. You have a housing bubble fueled by toxic subprime loans, which are then securitized into fake safe bonds, which are held by massively leveraged banks, all of which is insured by a company that doesn't actually have the money to pay the claims. It's a house of cards soaked in gasoline.
And in 2006, the match was lit.
It was.
Which brings us to Section 5, the collapse. From contained to catastrophe, what was the first domino to fall? What was the trigger?
You know, it wasn't a sudden explosion at first. It was more like a slow leak. Housing prices officially peaked in the U.S. in mid-2006. They went flat, and then they started to tick down.
And at the same time, the Federal Reserve had started raising interest rates to try and cool down the economy.
That was the double whammy. Those teaser rates on the 228 ARMs started to reset. Suddenly, homeowners saw their payments jump by hundreds, sometimes thousands of dollars a month.
So they tried to do what the broker told them to do. They tried to refinance.
But they couldn't. Because to refinance, you need equity in your home. And for the first time in years, the value of their house hadn't gone up. It had gone down. Many of them were underwater. They owed more on the mortgage than the house was even worth.
So the defaults started to spike.
And this is the beginning of the vicious cycle. Defaults lead to foreclosures. The bank takes the house and puts it on the market. That adds more supply to the market, which pushes prices down even further. Lower prices put more homeowners underwater, which leads to more defaults.
It just feeds on itself.
It does. And as those defaults rose, the waterfalls in those CDOs started to dry up. The toxic waste bucket emptied. Then the mezzanine bucket. And then, the moment no one thought was possible, the AAA bucket, the safe money, wasn't getting paid.
And that's when the panic hit Wall Street.
The timeline here is important. The first signs of trouble were the subprime lenders themselves going bankrupt in early 2007. Companies you've never heard of, like New Century Financial.
At the time, the Fed said the problems were contained to the subprime sector.
They did. That was the official line. But the contagion spread to Wall Street in the summer of 2007. July 2007 is when it got real.
Bear Stearns.
Two of Bear Stearns' internal hedge funds completely imploded. They were stuffed to the gills with these subprime CDOs. That was the proximate catalyst, as the SCIC called it. It was the moment Wall Street looked around and realized, oh no, the toxic waste isn't just out there, it's inside the house. It's on our own balance sheets.
And this leads to the modern version of a run on the bank. But it wasn't people lining up at teller windows like in the old movies.
No, this is a silent, invisible run happening in the repo market.
We need to explain the repo market because this is the plumbing of the entire financial system that nobody sees.
Think of the repo market as a giant overnight pawn shop for banks. Investment banks like Bear Stearns and Lehman Brothers need massive amounts of cash every single day to operate and settle their trades.
So where do they get it?
Every night, they take their assets, their bonds, their CDOs, and they essentially pawn them to other lenders, like money market funds, for cash. They sign an agreement to buy those assets back the next morning for a slightly higher price. That's the repurchase agreement, or repo.
So they are literally living hand to mouth, night to night.
Every single night. They are rolling over billions, hundreds of billions of dollars every night. The system works fine as long as the lenders trust the collateral, as long as they trust the bonds being pawned.
But in 2007, they stopped trusting the collateral.
They looked at the mortgage-backed securities being offered up by Bear Stearns and said, wait a minute. We don't know what this stuff is worth. We don't want your bonds anymore. We want our cash back.
The pawn shop closed its doors.
And if you're an investment bank and you can't get that overnight loan, you are dead by morning. You can't open for business. That is what happened to Bear Stearns in March of 2008. They ran out of cash. The Federal Reserve had to step in and orchestrate a fire sale to JP Morgan Chase just to prevent a disorderly collapse that could take down the whole system.
And after that, everyone took a breath. They thought, okay, The Fed saved Bear. The worst is over.
They thought they had dodged a bullet. But it was just the warm-up act for September 2008.
The critical month.
September was the avalanche. First, early in the month, Fannie Mae and Freddie Mac, the two government-sponsored giants that owned or guaranteed half of all the mortgages in America, were effectively bankrupt. The government had to take them over, nationalize them.
Then Lehman Brothers.
Lehman was in the same boat as Bear Stearns, but much worse. They were leveraged to the hilt with toxic commercial and residential real estate assets. They were running out of cash. They desperately needed a buyer or a bailout.
But the government, specifically Treasury Secretary Hank Paulson, decided to draw a line in the sand. No more bailouts.
They were worried about moral hazard. They wanted to teach Wall Street a lesson, to show that there are consequences for reckless behavior.
So on Monday, September 15th, 2008, Lehman Brothers filed for bankruptcy. It was, and still is, the largest bankruptcy filing in U.S. history. And the result was immediate global chaos.
The system broke. The TED spread, which is a key measure of trust between banks, it skyrocketed to levels never seen before. It meant banks stopped lending to each other, period. The circulatory system of the global economy stopped flowing.
And then the panic, which had been confined to Wall Street, hit the average person. It hit Main Street with the money market funds.
This, for me, is the single scariest moment of the entire crisis. The Reserve Primary Fund, a boring, safe money market fund where regular people and companies kept their cash. It held some Lehman debt. When Lehman failed, the fund broke the buck.
Meaning a dollar that you invested was suddenly worth only 97 cents.
It doesn't sound like much, but it was earth-shattering. It was like discovering the laws of physics no longer applied. It caused a stampede. People and corporations started pulling hundreds of billions of dollars out of every money market fund.
Because they were terrified.
If the government hadn't stepped in within 48 hours to guarantee those funds, the entire economy would have ceased to function. Companies wouldn't have been able to make payroll. ATMs might have gone dark.
It was that close.
It was the brink of a second Great Depression. And in the middle of all this, AIG collapsed. All those credit default swaps they had sold came due at once.
And they didn't have the money.
Not even close. And the government realized they couldn't let AIG fail because AIG owed money to everyone. If AIG went down, Goldman Sachs goes down, major European banks go down. It would have been a global financial Armageddon.
So they bailed them out. $85 billion initially.
It eventually grew to much, much more. It was a total, complete systemic meltdown.
So naturally, after a catastrophe of this magnitude, we have to ask, who is to blame? And the sources we've reviewed, they present a few different, often competing narratives. It's not just one villain twirling a mustache.
It's a cast of thousands. The first and maybe the most prominent narrative is Wall Street greed and deregulation.
This one focuses on the idea that the government took the referees off the field and let the players run wild.
Exactly. Proponents of this view point to a few key decisions. The repeal of the Glass-Steagall Act in 1999, which tore down the wall between boring commercial banking and risky investment banking.
So banks could gamble with their depositors' money.
In a way, yes. They also point to the Commodity Futures Modernization Act of 2000, which specifically stated that derivatives, like credit default swaps, would not be regulated by anyone.
They created a completely dark, multi-trillion-dollar corner of the market where anything goes.
And then there was the SEC's decision in 2004 to allow the biggest investment banks to dramatically increase their leverage. The regulators were operating under this free market philosophy that markets correct themselves. Well, they didn't. And the FDI warned of an epidemic of mortgage fraud as early as 2004, but very little was done.
Okay, so that's narrative one. But then there's a competing narrative, one you still hear a lot, which is that this was actually the government's fault. It was government housing policy.
Right. This is the argument that the government essentially forced banks to lend to people who couldn't afford it. This argument focuses on things like the Community Reinvestment Act, or CRA, and the affordable housing goals that were set for Fannie Mae and Freddie Mac. The claim is that bureaucrats in Washington were pushing for looser lending standards to promote homeownership among lower-income communities.
But the sources, especially the official FCIC report, seem to debunk this pretty hard.
They do. The FCIC conducted a very thorough investigation and concluded that, 1, the vast majority of the toxic subprime loans were made by independent mortgage companies that weren't even subject to the CRA.
So the law didn't apply to them anyway.
Right. And 2, the loans that were made under the CRA's framework actually performed better on average than the private label subprime stuff that Wall Street was churning out.
And again, there was a massive housing bubble in Spain and in Ireland and the UK. They don't have a Community Reinvestment Act.
Exactly. It's hard to blame a U.S. domestic policy for a global speculative mania.
Which brings us to the third narrative, the one that maybe hits a little closer to home for all of us, the consumer.
We can't let ourselves as a society off the hook completely. Households took on massive, unsustainable amounts of debt. People began to treat their homes like ATM machines.
Cash out refinancing.
Yes, they would see their home value go up, so they'd refinance a mortgage, take tens of thousands of dollars of equity out in cash, and use it to buy boats, cars, vacations, flat-screen TVs. The national savings rate plummeted.
And there was also the new phenomenon of strategic default.
This was a really interesting and controversial new behavior. This wasn't people who couldn't afford to pay their mortgage. This was people who could afford to pay, but they looked at their home's value, saw it was now worth less than the loan, and they made a cold, rational business decision to just walk away.
They mailed the keys back to the bank. Jingle mail.
Jingle mail. And left. It arguably broke the social contract of debt, the idea that you pay back what you owe.
So it sounds like everyone is guilty. The regulators, the bankers, the rating agencies, and the borrowers all playing a role. The result was Section 7, the aftermath.
The human cost was just immense. We talked about the $13 trillion in lost wealth. But in terms of jobs, nearly 9 million jobs were lost in the U.S. Unemployment doubled, hitting 10%.
And the foreclosures, the number is just gut-wrenching. Up to 9 million homes entered foreclosure between 2009 and 2011.
Think about the trauma of that. 9 million families evicted, lives upended, communities blighted with vacant homes. And the recovery was the slowest since World War II. We had this zombie economy for years.
The government's response was, of course, the controversial TARP, the Troubled Asset Relief Program, the $700 billion bailout for the banks.
And the Federal Reserve's response was to slash interest rates to near zero, where they stayed for years, and to start quantitative easing. Basically printing money to buy bonds and inject cash into the system.
Now, here is a fact that always surprises people when you bring it up. The bailout money for the banks. We actually got it all back, didn't we?
We did, with interest. As of 2021, the sources say the Treasury had fully recovered all the TARP funds, plus about $109 billion in profit for the taxpayer. Financially, the government came out ahead.
But socially.
Socially and politically, the cost was incalculable. There was this profound sense of injustice. We bailed out the banks, the architects of the crisis, but we didn't really bail out the homeowners who were losing everything.
The arsonists got a golden parachute while the victims got burned.
That perceived unfairness changed American politics forever. You can draw a straight line from that anger to the rise of the Tea Party on the right, Occupy Wall Street on the left, and the populist movements we still see today.
And we got the Dodd-Frank Act in 2010.
The big regulatory reform package. It was an attempt to fix the too-big-to-fail problem. It created the Consumer Financial Protection Bureau to stop predatory lending. It tried to bring some light and regulation to the shadow banking system and the derivatives market.
But the big question is, did it fix the root cause?
That is the multi-trillion-dollar question.
And I think that leads us perfectly to our final synthesis. You look at this whole story, and it really was a perfect storm. You had low interest rates from the Fed,
mixed with that giant global pool of money hunting for yield,
combined with lax regulation and a free market ideology.
Fueled by financial innovation that was brilliant, but ultimately toxic.
And all of it built on a foundation of bad incentives and a mass delusion about housing prices. It was a disaster waiting to happen.
It was. And the recovery, what some call the zombie economy, had these lingering effects, especially on millennials. They entered the workforce in the worst job market in generations, saddled with student debt, and their rates of home ownership still lag behind previous generations. The crisis left deep scars.
So for our final provocative closing thought, I want to reference something the economist Robert Shiller said. He argued that bubbles are primarily social phenomena.
That's the thought that keeps me up at night. I think we've done a decent job of fixing the plumbing, the specific mechanisms of the 2008 crisis. Banks have more capital. The rules around mortgages are stricter.
But have we fixed the psychology? Have we fixed the human brain?
Exactly. Have we cured ourselves of the fear of missing out, of greed, of the belief that this time is different?
The mechanisms change, but the behavior stays the same.
It does. Maybe the next time it's not subprime mortgages. Maybe it's crypto or private credit or some new tech stock bubble. But as long as you have a period of cheap money and a compelling story that says prices can only go up, you will get a bubble.
And you will have financial engineers in the background figuring out new ways to turn dross into gold.
Always.
A very sobering thought to end on. We have barely scratched the surface of the thousands of pages in these reports. If you want to see the emails, the charts, the actual crime scene photos from the financial collapse, check out the links in our show notes.
It's a deep rabbit hole, but it's worth going down.
Thanks for taking the deep dive with us. We'll see you next time.